CIPO. But let's also welcome on board Rama Mohan Rao Amara, MD and CEO at SBI Card, joining in on the show right now. Mr. Amara, good to have you on the show. You've ended FY22 on a strong note. What supported the performance and how is it that you see FY23 play out?
Yeah, even though we began the financial year on a slightly shaky wicket, particularly on account of a second wave, we were able to come back very strongly by end of the year. All our key business metrics recorded robust improvement. I will take you through a couple of metrics just to understand how our strategies have actually helped us in terms of recording a strong performance. New card issuance or new account sourcing crossed 3.5 million, which is at a growth of 33% year on year. What is more notable is it went on, the run rate increased each quarter on quarter. Last couple of quarters, like a December quarter and March quarter, we crossed 1 billion in terms of new account sourcing. Spends wise, both retail and corporate spends have been quite robust. In the second quarter of the financial year itself, we crossed the pre-COVID level. That is the case with both industry and SBI Card. Retail grew at around 43% and corporate was almost 100%. Then, of course, we had a strong NEA growth, 25% year on year. As we have guided earlier, the credit cost continue to follow the downward glide path, whatever we have guided. And almost they have reached the pre-COVID levels. Collection efficiency has come back. This has actually helped us in terms of containing the credit cost. Even the ECL, which is an indication of what is the forward-looking provision, that has come back to the pre-COVID levels, while the gross credit cost for Q4 is just above 5%. It is also trending towards the pre-COVID level. I think we have a bouquet of right products, right partnerships, our strategies, whatever we had. Whenever we do that, we always keep an eye on the sustainability and profitability. I think all these things have helped.
Right. Also, I wanted to understand, your spend growth is pretty solid at about 50%. Your card growth is at 17%. Your receivables at 30%. And these are all year-on-year numbers that I'm picking out. Where is it that you see your growth and card spends normalizing?
As I said, the spends wise, overall spends crossed pre-COVID levels, which shows the revival of consumer confidence. If I focus on Q4, which is a better indicator of recent consumer behavior, I think the online spends share continued to be more than 54%, which is much higher than what we have seen in the last financial year. And segment-wise, when I look at particularly some segment more like a discretionary spends, consumer durables or furnishings or hardware, etc., even the POS has recorded quite a good improvement in Q4 versus Q3. Of course, barring the travel, entertainment, restaurants, or air travel, etc., which slightly got impacted in the month of January, overall it remained below pre-COVID levels. But rest of all the segments of spends, we could see, it recorded both quarter-on-quarter improvement as well as they are much above the pre-COVID levels.
Now, SBI Card has lost a slight bit of market share. It's just probably 10 bips. Is that a concern?
I think first of all, I will talk about our acquisition philosophy or strategy. Then I will talk about the industry. Our acquisition strategy is always looking at what kind of distribution network we have, what kind of partnerships we have, and what kind of access to the databases we have. It's always looking at these things, taking them into account, and a kind of internal risk appetite what we have, and then targeting certain sustainable growth. As I said earlier, the kind of quarterly run rate what we are recording in terms of a new account sourcing, it has steadily increased, which is an indication that our strategy is working. Coming to the industry, we have seen a kind of play by both existing players as well as a new set of players. This has definitely expanded the base. It's a good thing, given the kind of very low penetration of the card industry, which is hardly around 4%. I think there is ample room for every player to play. But only question is when we pursue market share growth, we always want to keep an eye on the profitability and sustainability. That way, I cannot comment on specific number what we are targeting, but definitely we will be looking at arresting the market share, but at the same time not losing sight of profitability.
The golden question is what happens as MDRs continue to be driven by regulators. Is there a visibility on Reserve Bank of India, on RBI, and how will this change your financials? Is SBI prepared for it?
I mean, what we understand is like there was supposed to be a discussion paper to be released by RBI and placed in public domain for getting the inputs from the industry and players. I think it is yet to happen. So in the absence of it, we don't know like what are the whether MDR is going to be impacted and if it is impacted to what degree. But all along we have maintained a particular stance that actually credit card is very different from any other mode of payment in as much as the funding cost is borne by the card issuer. Risk is borne by the issuer, and then there is a strong reward and value proposition behind the card. Obviously, all these things we were able to articulate well in the past whenever there is a question of revision of MDR, and we hope this time also we will be able to succeed. But having said that, if at all if there is a situation where MDR changes, we do have these kind of levers where we can tweak with the credit period if required, and maybe change the value proposition and the reward cost. Not impacting the attractiveness of the product. Of course, we'll keep that in mind. But overall, we are confident that it is manageable.
Sure. RBI has issued directions for credit and debit cards. Tell us your views on what is good, what is bad for your business, and how is it that you actually see this impacting you?
I think broadly it is based on a kind of preliminary assessment at our end. It is a step in right direction because it is aimed at enhancing the consumer protection, improving the transparency. But as a large player in the industry and being part of SBI Group, we always believed in following the code of conduct, ethics, or fair practices code. So we don't see a challenge in terms of complying. We are already compliant with most of the provisions. Including the provision relating to the co-branded cards, where certain expectations are there from the regulator, very clearly they have articulated. But as with any regulatory change, we will have to carry out some internal changes in the internal processes and systems, etc., which may take some time. And of course, they will be completed well before the timeline. But even if a small slowdown momentum is there, that is only momentary. As is the case with industry, always it bounces back after any regulatory change, after figuring out how to engage with the customer and how to sustain.
Right. So in terms of technology, what one is seeing is that a wide range of alternatives are available for cards these days. Would you say that the climate is getting more and more competitive and the RBI acknowledges these alternatives as well?
I think credit card industry has always witnessed intense competition, and that has always been there. And now, of course, it is further intensifying on account of action by the existing and the new set of players. Of course, alternatives are also developing. Particularly if you are looking at a BNPL, buy now, pay later kind of a product, it has become quite popular. When we analyze, it is mostly serving the credit underserved kind of segment. Largely students, first-time jobbers or housewives kind of segment with a transaction size typically being around 3,000 to 15,000 rupees, barring the outliers. So this segment can have higher credit cost. So sustainability in the long run, profitability, etc. These are yet to be assessed. But having said that, we do have a positive rub-off of the change in the consumer behavior. There is a clamor for EMI kind of loans. We position ourselves well with the right strategy and with the right pricing. So our EMI portfolio has actually increased by 5 percentage points year on year from 29% to 34%. And if you say like what will happen to the industry, given the kind of low penetration and still the economy being largely cash driven, I think there is ample opportunity and scope for every player to thrive. So it is in the interest of the customer that they have a wider choices. And it is always in the interest of the industry also. In any intensified competition keeps us agile and it keeps us on course. So we are not better.
All right, Mr. Rao, appreciate your time. Thank you for joining us. Well, this week it's all about US Fed and what we should expect. Broadly, the street consensus view is a 50 bips rate hike. This is the first time Fed will increase